Here we're going to talk about a technique that is extremely powerful in the overall market. I mean, it's called mirror images, and what it is basically using finding a part in the pattern that you believe is starting to repeat, but kind of in the inverse way of the other pattern. And I remember when I first learned this technique, it was quite some time ago, and when I employed it, as everybody should be, you're a little bit skeptical, especially in its initially when you start to learn it, and you want to make sure you're doing right by it. And it was just amazing the predictability it had on it, and its uncanny accuracy to eventually call a low from, I think the stock was up at, I think, in the 17 range, and I called for it to eventually go down to 4 based upon a lot of this type of analysis. And it was amazing in how it happened, and it also could create and also understand that there would be a pretty good free fall with the issue based upon the way the chart looked. So as I tell you this, I really wouldn't underestimate the ability of this type of analysis, and it's very powerful to be done. It's been done for quite some time, and many have done it. There's several that have really refined it. But the gist of what you're really trying to do is find a point in the pattern that you believe is the starting or the spot where you would fold the paper, basically. So if we were to look at it here, we would look and say that would be a good point of what we're seeing. And what you do is you kind of draw some important points in the chart. For example, here we have here right here. Now, what we could do too is that sometimes it is very subjective. So what you want to do is you have to be understanding and very everything can't be exactly precise. You're getting an estimate of what could happen. And let me draw this again. Okay, now you would see you could see this clearly comes here. You see another move as it tries to rally, but it fails. Then you see another move to the downside, and then you see another rally and it fails. Then it comes to the low. So that's what we see on this issue. Then we could say, well, we have this kind of a move, and then we see the recovery, and then we see another down move, and then we see the other swing. And you could say that there was one little quick movement too, and that you could make a case on that. But we're going to leave it at this. And then we're going to see this next move, and then we see the correction. We see the other move. We see the correction. We see this huge move here. And then we see the corrective move. Now you could say, well, you see a small swing here, and what happens is on this side, especially on the bearish, you could see this was really the swing back. But what happens is, because it's so dramatic and the bearish side is always a little more accelerated, you don't sometimes see as many of the counter moves, which makes perfect sense when you think about it. And then, what we could see here in this last move, here we're going to see this move here, and then we see the counter move, and then we see this, and then we see our move up. And we can even say here we see this next jig, and then we're back up in here. So what you're seeing is very, very similar pattern if you were to figure out where it would be going. So you're saying basically you could see this accelerate back up into this 21 range. But after that, you have to kind of understand that you may start to see this really come back down, just as that pattern came, and you may get a move. So when you look at this, you could tell that it is very, very close to the same pattern. And this means that it may run right back up to the prior swing high here. And it's a very good shot of that happening. When it does come back to that, you have to be more cautious as usual, because you may be seeing the end move here on this.